Good morning, everyone. Now we are moving ahead to the next session. Now I would request CA Anjali ma'am and CA Shikha Agrawal to escort our esteemed faculty to the dais. Padma Shri Cresto from Mumbai, Deepa Agrawal from Delhi, and Anita Somani from Mumbai, and our loved one CA Anjali Choksi ma'am. Put your hands up together. और अभी का हमारा जो सेशन है वो फिनेंशियल स्टेटमेंट एनालिसिस के ऊपर है. फर्स्ट ऑफ ऑल जितने भी हमारे साथ आज एस्टीम फैकल्टीज़ जुड़े हैं उन सबका एक इंट्रोडक्शन, छोटा सा इंट्रोडक्शन के साथ आज के ये सेशन की शुरुआत करते हैं. फर्स्ट ऑफ ऑल पद्मश्री क्रेस्टो फ्रॉम मुंबई, पार्टनर, हेड ऑफ मॉनिटरिंग एंड remediation, risk and quality, and head corporate legal at MSKC and Associates, passionate about the audit quality, ISQM, AQMM, and related the emerging aspects. FCA with 20 years of experience in audit and quality. Being HMR, leading the audit quality initiative like engagement, inspections, AQMM implementation, risk management, and regulatory reviews and matters. Speaker at various forums, contributor to WIRC publications, part of study groups and committees of ICAI. Put your hands up together for Padma Shri ma'am. And would request to Anjali ma'am to give a token of love from our institute, a memento. Thank you ma'am for coming. Now we have Deepa Agrawal ma'am from Delhi, CA, DISA, CPA from Australia, author, assurance partner at SR Bartley Boy and Associates, Substantiality, Global Professional Practice, Special Invitee AASB, General Committee BCAG, Technical Advisor, and a Chartered Accountant with 13th rank in India, having the experience of 19 years in the accounting, auditing, corporate law, and other matters. Author publications and articles working in the professional practice team of SR Bartley Boy and Company, LLP and auditing, quality and regulatory matters, work with the consultancy firm as a part professional practice, special invitee in the corporate laws and government committee, audit and assurance standard board of ICAI in 2018 to 2019. Please put your hands up together for Deepa Agrawal ma'am, and would request to Shikha and Anjali ma'am both to give a token of love, a memento to Deepa ma'am. Now we have a third panelist, Anita Somani ma'am from Mumbai, a partner, audit and assurance, BDO Mumbai, specialize in the audit and review of financial statement and system of global entities and large Indian conglomerates. Having a more than 14 years of experience providing the financial statement audit and accounting advisory service in India, experience cuts across various industry sectors, and experience also spends conducting the audit of financial statement prepared under US, GAAP and IFRS. In the addition, also experience in the dealing with the capital market transactions in India. Put your hands up together and would request to Anjali ma'am and Shikha to give a token of love and memento to Anita ma'am. And now we have in this panel discussion Dr. CA IPRV Independent Director Anjali Chokshi from Ahmedabad, FCA PhD in Derivatives, Insolvency Professionals, Independent Board Director, Registered Valuer, and our immediate past chairperson of ICAI Ahmedabad and partner DG Anvi and Company, and awarded the India's top 100 women in the finance by AIWMI. Put your hands up together and would request Shikha and our esteemed panelists also join this memento token of love. Thank you so much. And now I would request to Shikha. Shikha is the moderator of this session. And for moderating this session, we would love to give the moment of love or moment of token to the Shikha also. Would request to all panelists and Anjali ma'am.
Thank you so much, Bhumika Ben. Good afternoon, everyone, and warm welcome to this panel discussion on financial statement analysis.
One minute. Would request all panelists and Anjali ma'am to give a token of love and memento to Shikha Agrawal. थैंक यू सो मच. अभी हमारा ऑफिशियली सेशन हम शुरू करते हैं. हाँ, वन मोर अनाउंसमेंट टू ऑल ऑफ यू. वन सरप्राइज गिफ्ट इज़ देयर टू एवरीवन, फॉर एवरीवन. सो कोई भी जा रहा है तो प्लीज़ वो अपना गिफ्ट लेके जाना. थैंक यू सो मच.
बट जाने के लिए नहीं बोलिए आप.
हमने एक दो लोगों को जाते हुए देखा, इसलिए ये अनाउंसमेंट करना ज़रूरी था. हम तो ऐसा चाहते हैं कि आप लोग हमारे साथ 6 बजे तक यहाँ पे जुड़े रहिए और ऐसे जितने भी सेशन हो रहे हैं वो सब हम लोग साथ में मिलकर एंजॉय करते हैं. थैंक यू.
Thank you so much, Bhumika Ben. Once again, good afternoon, everyone. A warm welcome to this panel discussion on financial statement analysis, unlocking insights for better decision making. हम लोगों ने अभी कैपिटल मार्केट सीखा है, अब उसके लिए फाइनेंशियल स्टेटमेंट को कैसे एनालाइज करना है वो सीखेंगे ताकि हम स्टॉक्स को आइडेंटिफाई कर सकें किस में इन्वेस्ट करना है. आई एम शिखा अग्रवाल and I am delighted to serve you as a moderator today. Financial statements are just not the numbers, they are the story of a business. Today's discussion aims to explore how we can interpret that story to make strategic and impactful decisions. We are fortunate to have us with an esteemed panel of experts who bring diverse perspectives to this topic. Let's expand a heartfelt welcome and show our appreciation with resounding applause. Resounding applause. Before we dive in, I encourage the audience to think critically and note down your questions we will take at the end of the session. Now I'll begin with first question with the Anjali ma'am. What is financial statement analysis and what are different types of financial statement analysis?
Thank you, Shikha, for starting with the basics. I know we all are chartered accountant, but let's refresh our concepts. Analyzing financial statement is basically broadly studying the interrelationship between the financial statements. We broadly considered only 3 financial statements: balance sheet, P&L, and cash flow statement. But there is one more added to that, that is statement of owner's equity and shareholders fund. NDS 1 considered it to be a part of the financial statement. So we all know balance sheet, it shows the financial position as on a particular date or for the reporting period. Profit and loss account, for a given period we know the profit and loss. Cash flow, the sources and application of funds. And statement of shareholders or owners equity tell us the changes in the shareholders fund during the year. As far as the types of financial statement analysis is concerned, of course we are going to talk about the technology, but again basic vertical analysis, horizontal analysis, and ratio analysis. By horizontal, we mean we are going to study the trend, right? We are going to know how we have performed as compared to the last year. It is also known as trend analysis, where we take 1 year as a base year and we try to find out the performance of the current year with compared to the base year. So we can do it for balance sheet, we can do it for cash flow, and we see how we have performed over the years. By vertical analysis, we mean each item is expressed as a percentage of the base item. For example, all the items of balance sheet expressed as a percentage of total assets. P&L account, all items expressed as a percentage of total sales. So that the base is taken as 100%, and then each item is expressed as a percentage of that total item. That is vertical analysis. Moving to ratio analysis, of course, now in balance sheet we have ratios, important ratios mentioned in the balance sheet, and it still continues to be the most important indicator, where we try to express the relationship between two items. It can be from one financial statement, or it can be from one from balance sheet, one from cash flow, and vice versa. And depending upon the information we are retrieving, there can be profitability ratios, there can be liquidity ratios, we can know about the debt coverage ratios, we can know about the return on capital employed, return on shareholders fund. So depending upon the requirement of information, we can find out the ratios.
Thank you, ma'am.
Of course, we would be talking about the more tools and softwares available, because now everything is readily available. It is where we have to use our mind. बाकी सब calculation तो आराम से हो जाता है.
Thank you so much for refreshing us about the financial statement. Now my question moves to all three faculties, this Padam Shri, Deepa and Anita. Why this financial statement is important, analysis is important for auditors? We can cover three different aspects.
So, why this analysis is important, or why
Auditors.
financial statements are so relevant, basically. So, the story of financial statement, the story of the company starts with the financial statements. Legally, we all know that after the formation of the company, within 15 months, you have to file the first financials. Then you have to actually file the financials on the annual basis. Why is it necessary for us? So we are in a typical zone, or we are a country where, unless like some other countries, some other geographies, maybe the Middle East, maybe the US, where the financial statements of private limited are not so important. Okay? Because their audit is mandatory only for a set of companies. But in India, we have financial statements which are actually, the audit is mandatory for all types of companies. Why? Because that builds a kind of trust that is more actually legally mandatory also, because we file the returns based on it, we cross tally those amounts with our tax audit, we cross tally those amounts with the other type of filings that we do, maybe the GST return, and hundreds of returns that we file. So financial statement is the origin, or I can say that it's the mother of all documents from where everything else emerges. So the trends emerge from that, the comparisons emerge from that, the health of the company can be measured from that. So n number of things, there are so many outputs that can be seen. So we have various auditing standards also, how we measure these financial statements, and why it is relevant for auditors or for the stakeholders. It's like it is the basis on which one will actually analyze, assess, make decisions. It is the base input for making decisions for any of the stakeholders. May it be investors, may it be banks, may it be regulators, may it be the departments, authorities, or it be the basic users of the financial statements. Even when there is a dispute or a case between minority majority shareholder, between two brothers, two directors, whatever, court will always ask for, show me the financial statements. Okay? If there is, obviously the dispute is on money. Money is the base of all disputes, right? So any kind of things, then the first thing that comes to mind is the financial statements. Financial statement दे दो ऑडिटेड दे दो, उसके बाद बात करेंगे, राइट?
Correct, correct.
बिना फाइनेंशियल स्टेटमेंट के कुछ भी आगे नहीं जाएगा.
Moving to Deepa.
Take this one.
Yeah, I think. So first of all, how many are the auditors sitting here? All are auditors? Fantastic. So I'm also an auditor. So I'll tell you why it's very, very important, because one is definitely it adds credibility to the financial statements. And if you see around, it's not just the financial statement, any kind of information which the regulator is looking at, they want us to certify. They want us to add the credibility. And that's why it's very important to understand that when we are looking at the financial statement, we have to be extra vigilant. We have to look from the eyes of the auditor, because tomorrow the world at large, the stakeholders, as Padam Shri mentioned, the stakeholders, the lenders, bankers, even the investor, you really enjoyed the previous session, right? So everyone is relying on the financial statement. You're looking at the top line, bottom line. What are the profit? What is the company doing? What is the financial health of the company? Therefore, it's very important for the auditor. And most of all, what I would like to add here is the regulatory environment. Everyone would have heard about the regulators being set up, the super regulator, NAFRA, the MCA, the ROC notices, the QRB inspection, FRRB. It's very, very important that the auditors should kind of think about what is something, extra the auditor needs to do. So while you look at the financial statement, look at the accounting standards, look at the auditing standard, but what is something which is missing, which is not there, but you have to apply your professional judgment. So I think that is the overall underlying message, and we will do a deep dive into some of the important issues from the eyes of the auditor. But all I can say that I think world is looking at us when it comes to the credibility of the financial statements. Thank you.
Thank you, Deepa. Now, according to the Anita, what is your viewpoint about this?
So, yeah, I'm an auditor myself, so absolutely financial statement analysis is the key point, and those who are the auditor would relate to me, is the first process while planning an audit, right? We do the financial statement analysis to identify how the company's health is, where the company is going at, how the company has performed compared to last year's. It's the key thing for, as an auditor, if I just say as an auditor, as an investor, there are multiple reasons why you do financial statement analysis. But as an auditor, the key reason for us to identify what we want to audit, right? What are we planning to audit? The areas is come out of one of the process we do is a financial statement analysis, which is mainly the horizontal analysis first, which we the current year we benchmark it with the previous year, or with the expectation, or with the budget of the company. So the comparative with which you want to benchmark the current year could be anything which is more relatable, and then you identify the trends which are not matching, or which doesn't gel with your overall understanding of the either industry or the company, and then you identify as an auditor and start to deep dive. And what I mean by deep dive is you start to focus on that area as a more of an audit, or you identify the key unusual transaction that also can be fall out of the financial statement analysis, and then you identify and then you say that this is the area where I want to focus more, or this is the area where I want to audit more. So for as an auditor, this is one of the very key step in planning an audit itself, to go right about audit. So that's my smaller view on the financial statement analysis. Obviously, it gives you a lot more larger qualitative comfort as well. Some of the financial statement analysis, when they are so vitiated or so haphazard that you immediately by looking at it, the trend, you'll think about the company's going concern. You'll think about the viability of the company's future. So those kind of a things also, those kind of a messaging also comes out of these analysis. So these are very important to understand the health of the company and how you can plan an audit as an auditor. So that's.
Thank you so much, Anita. Now this question is for Deepa. What are the three key red flags in the financial statement? What are the focus area for shareholders, investors, regulators, and even the auditors? If we want to take a new assignment as an auditor, what we should focus on?
Yeah. Thanks, Shika, for asking this very relevant question. And I think Dr. Anjali mentioned in her opening remarks, how do you do an analysis of the financial statement? So I think whenever you accept a new audit engagement, or even when you're looking at the financial statement, it's very important to see the comparatives. What is my comparative? What is the change as compared to the previous year? Has the expenses been really moved up, or are the additional provisions made by the company? What is the assets and the liabilities of the company? So I think the comparative analysis is a must to understand the movement in the balance sheet. And the other is the changes in accounting policies. So everyone reads the accounting policies. The detailed accounting policy is given at the end of the financial statement. So when we talk about the financial statement, it's not just the P&L balance sheet, a statement of changes in equity. Notes is something very, very integral. One has to read the notes to the financial statement. And if you look at our Indian framework, we are not just restricted to the accounting standard. We have our Schedule 3, we have our disclosure coming from the Companies Act, we have disclosure coming from the SEBI regulation when we talk about the listed entities. So therefore, the regulatory regime is very wider, and therefore it's very important to look at that analysis when you are especially accepting it for the first time. The other point I want to make is the favorite area for the regulator is the related parties. So you would have heard about the recent study and the news articles issued by SEBI, one of the research study on royalty payment. So SEBI keeps on conducting these studies, and now we are in the era of artificial intelligence, and I'm sure one of my colleagues will talk about technology here. They are also very expert on the technology. They are collecting the data and doing lots of analysis to see what are the company's trend, how much has been paid to the related parties. So if I just talk about related party, especially for a listed entity, it's wider. You look at the definition of the Ind AS or the applicable, whatever the standard is, and then you look at the identification of related parties as per SEBI regulation. It's much wider. So even any entity which is related to the promoter is a related party, to give you an example. So it is such a wider term, and therefore identification is a challenge. And you can see a lot of FRRB publication of reports, QRB reports, even the NAFRA report, they talk about related parties. The companies have not identified related parties completely. They have not given the disclosure of the transaction appropriately or completely. They have not disclosed the nature and relationship of the parties. So that is one area probably that should be focused and looked at. The other is impairment. Impairment is also a very important area, because how do you determine that impairment? Is there something, for example, goodwill, there is a requirement to test it annually. So whether the companies are doing it correctly, they have written in the policies, are they doing it correctly? Whether provision has been made. Especially when I talk about the role of the auditors here, are they really just relying on the valuation report, which is on year to year? The management gives the valuation report and says, okay, this is a valuation report and there is no impairment. Is the auditor really challenging that valuation report? Are they looking at the indicators of the impairment? Another factor which I can talk about, based on my experience, is regulator. So while we are just talking about a high level on the financial statement, the climate-related risk is another thing which has come up. The regulators have started monitoring it. The companies which are really causing, all these, which has the health issues or the safety issues, or they're at such places which may really be, caused to the climate change. Are they really taking into account those risks when they're making those assessment? So these are some of the areas, and the list is endless, but I'll take a pause here and we'll give the mic.
Thank you, Deepa. As Deepa has mentioned about Schedule 3, so what are this question goes to Padam Shri. What are the implications of Schedule 3 for different shareholders as investors, creditors, and management when analyzing financial statements? What are the specific sections in Schedule 3 that are useful to analyze financial statement?
Yeah, so the very fabric of financial statement is laid down by Schedule 3. So whether it be a private limited, listed, and going forward almost after the implementation of this guidance note on LLP as well as non-companies, it's almost everything is going to look like Schedule 3. So the T-type balance sheet is almost out of the window. It's gone long by, right? Now Schedule 3, when it got revised few years ago, the first thing that was coming to everyone's mind is, और कितना लंबा बैलेंस शीट बनाना है? ये तो चलते जा रहा है 10 पेज से 12 पेज 12 पेज से 18 पेज, it is going on and on. How much more? And in many of the sessions where we spoke about the Schedule 3, first question was, ये सब सबको करना है? You know, ये सब कुछ प्राइवेट लिमिटेड को भी करना है? अरे इतना तो कहाँ, अपने को फीस कहाँ मिलता है इतना? Right or wrong? These are the practical things. But as we speak, now we have inculcated it into our practice. It's no more alien to us. Karna hai Schedule 3, we have to do it. There is no two ways about it. How is it relevant for different stakeholders? When Schedule 3 was being revised, there were a lot of discussions on what all things have to be there, what all are not to be there. Now financial statements is not only based on Schedule 3, it's like the basic fabric is Schedule 3. If I'm talking about all the types of companies other than banks and insurance and few other typical companies, the basic thing is Schedule 3 and it is like a pizza base, right? उसके ऊपर टॉपिंग अपना आता है, अकाउंटिंग स्टैंडर्ड, कंपनीज एक्ट, MSME, जो जो चाहिए वो सब पिज़्ज़ा टॉपिंग डालते जाओ, राइट? So it's like it has become so much that it is like a farm fresh pizza with too much toppings. कभी कभी अच्छा नहीं लगता है एक्सेस का टेस्ट भी, but so it be. How is it relevant? It is relevant for everyone because now we have in Schedule 3 the reconciliation between आपने बैंक में क्या दिया और अभी यहाँ पे बैलेंस शीट में क्या दे रहे हो, right? At the end of the day, everything is going to be matching to each other. Why these things are coming out? These are actually fallout of all the things that we see in the newspaper. Someone took a projected balance sheet, took a loan of some amount, and then when the real balance sheet came out, it was far away. It was completely far away. That was in Kashmir, this is in Rameshwar. कोई रिलेशन ही नहीं. प्रोजेक्शन किधर गया बोले बता नहीं, वो तो बनाया था हमने, राइट? बैंक लोन के लिए प्रोजेक्शन कुछ भी बनता था, स्टॉक बेस्ड हाइपोथिकेशन कुछ भी बनता था, correct? So these implications actually work out to be the reality later, which makes the company go into troubles. So that's when these reconciliations have come. Then inventory. Main inventories, how different types of inventories are projected, broad-based inventory, क्या है basically. So initially there was no classification and putting out of those inventories in the balance sheet. At least broad category में समझे तो सही, उसके पास क्या है, right? So in a chemical factory, there may be high value chemical, there may be low value chemical. At least people will be able to understand, appreciate based on major types of products. Otherwise, he would have inflated everything. At least you will understand the market price of those products. So that's the difference that it makes. Then there is a very important section in the financial statements which actually completes your financial analysis end to end if it is given correctly. Which is that section? Ratios. Right? You have 10 different ratios. 10 to 12 different ratios. From current ratio to net profit ratio to debt leverage ratio. Everything you have. That's your financial analysis. When the ratios came, everyone said, अरे इतना ratio ही देना है. We will go back to our school days like TY BCom में चले गए सब. But then they understood, अरे इतना ही नहीं है, उसमें 6 column add हो जाते. How did you calculate? What is the numerator? What is the denominator? Current year, previous year, more than plus minus 25% give variation. But the thing is, it is always a fund of GIGO, right? Garbage in, garbage out. Still, you will find, you download many balance sheets. Now, we all know this financial analysis can be very sasta also. How? 100 rupees में balance sheet download हो जाता. Between evening 6 o'clock to morning 11 o'clock, morning 8 o'clock, right? You can download it, you can see. And in that ratio analysis, we have seen many people who are writing the remarks as sales has increased due to market conditions. Very good. Data has increased due to sales. Purchase has increased due to sales, right? Capitalization has increased because sales has increased because I want to produce more. Where is the analysis? So it is for us to look at which are the relevant portions. So Schedule 3 gives you a lot of these underlying evaluations ranging from your bucketing of datas, your MSME calculations, ratios, which is the most important fact if it is given well. Even from the calculations, forget about the explanations that they have written, which may not be useful, but even from the calculations, you can make out where are the things moving, how are the things moving. From the aging bucketing, you are able to make out what is it. Then this suspended project, in case of capitalization, CWIP, suspended project and running project. This was very helpful in terms of the COVID, because when during the COVID period, these 3 years, there were many projects which went into suspension mode, right? So all these types of analysis of information is readily available. There are softwares available to collate this information, okay, wherein you can get all these things by running some Power BI or something on the balance sheets of all these companies, and they will actually map it into industry reports also, and that's available. But as chartered accountants, we can actually plot these things into Excel. We are able to do that analysis. And why Schedule 3? Because of all these changes, it has brought so much of information that are handy. Now, I have discussed only 5 of them, 5 of the main things, right? There are, for each of the areas, there are more to come. And if the financials are made with proper diligence and the way it has to be, only the set of financials is more than enough to understand the company's health and how the company is progressing.
Thank you, Pradam Shri. As rightly said that it is a job of 100 rupees only. Then now the days of AI, Chat GPT and our CA GPT also introduced, and they can analyze financial statement in a fraction of second for us. So it's a matter. So now you have told about the pizza-based topping. There are one more topping, a Caro, revised Caro. This question goes to Deepa. Revised Caro was issued in 2020. So can you explain about interplay of some of the requirements in Caro and Schedule 3?
Yeah, thanks, Shweta. And I think Padma Shri mentioned about the size of the financial statement. I would like to take a minute to talk about the size of the auditor's report here, because we are going to touch Caro. So the auditor's report is not just your SA 700 report, which is based on your international standard. You have a good, very beautiful section report on other legal and regulatory requirement, where you have to talk about a lot of whole things in terms of Rule 11, which includes even your fraud reporting. And then last year, they added Rule 11E and F on about the ultimate funding, the ultimate beneficiary. Whether the auditor has, based on the management representation, they have obtained the information, and there is no, the funding has been given through an intermediary, which will ultimately be benefiting a third party. They added about the dividend reporting, and then recently, the last year, they spoke about on the audit trail reporting. So that is part 2. Part 3 is your ICFR reporting, which is, again, not limited to the listed companies. You have unlisted public companies also covered therein. And the part 4 is Caro. So what happened, the MCA thought that it's very important to look at the, auditor is not really reporting well. Let's add something more meat to it, in terms of the Caro reporting. And they added and they made substantive revision to the Caro, and they added significant reporting requirements. And I'm giving a bit of the background because I was part of the development of this entire guidance in Caro. And then they realized after notifying Caro that there is no corresponding disclosure in Schedule 3. So while they added a lot of disclosure requirement in terms of the Benami transaction, title deeds of immovable properties, ratios, based on the ratios, the auditor will have to report whether the company will be able to meet its financial liability, which are due for the period of 1 year or the 12 months from the date of the balance sheet. They realized after a certain point of time that the disclosure has to be first given by the management, and without a requirement from the regulator, companies will not make the disclosure at their own. So they revised the Schedule 3. And that's how you got additional regulatory disclosure requirement in Schedule 3. And they added 10 additional disclosure in Caro, based on which the auditor will, in Schedule 3, based on which the auditor has to report in Caro. So this is the interplay, and just a bit of a background, but I'll just be covering 2 or 3 clauses here, ultimately on which the auditor will have to report. So because of the increasing frauds and again looking up to the auditor, that the auditor is the one who should be reporting, who is actually looking at the balance sheet, financial statement, and therefore auditor is the right person to tell us everything is fine. The company is doing fine, and therefore they introduce these requirements. So one of the important laws is, all of you know about the going concern, right? The auditor will have to make an assessment of going concern. Now, in addition to the going concern assessment on which the auditor has to report in the auditor's report, what the MCA did, they introduced a clause in CARO wherein the auditor has to look at the ratios which has been disclosed by the company in the financial statement, and then considering the ratios and the other information and the financial assets and liabilities of the company, they will have to make an assessment saying that the company will be able to meet all its financial obligations which are due for the period of next 12 months from the date of the balance sheet. So it's like a solvency. It's like a statement for the solvency of the company. And obviously there were a lot of discussions around it. Then when the auditor is doing the going concern assessment, why this is required, but no, they really want more from the auditor. So that is one clause, and correspondingly, the ratios were added. There were many more changes being made. The second thing is about the title deeds of immovable property. So they did added a corresponding disclosure requirement in Schedule 3, wherein the company will have to make a disclosure where the title deeds are not in the name of the company. And you can look at the FRRB reports also, wherein there are observations around it, where the disclosures have not been made appropriately. The company has simply written that it's under process. Now, that is not sufficient. The reason has to be given. And additionally, one more beauty I'll add to this. If you look at the guidance note in CARO, it says that if the disclosure has been given by the company in Schedule 3, the auditor will still have to report about the specified disclosures in the CARO report. So when I'm reporting, I'll still have to talk about whether the title deeds of immovable property have been disclosed by the company in the specified format. So I can't just simply make a cross-reference to the disclosure made by the company. While I can make a reference if it has additional information, but I still have to report everything in CARO. The third thing which I want to talk about is the working capital limits. So there's a clause which was added about the working capital limits to where if the company is obtaining any working capital limits based on the current assets, then is it something, whatever quarterly returns have been furnished to the bank, it is in accordance with the books of account maintained by the company. And there were a lot of debate again around this, that there is no requirement for quarterly audit for the unlisted company. So how it is going to happen? Who is responsible for the differences? So, and therefore they added the corresponding disclosure in Schedule 3 also. So in total, there are such 10 requirements, which you can have a look. So at the end, in the CARO, I can only say that reporting requirement has been increased significantly. Please have a look at the guidance note. Please look at the checklist. There are very good checklists given at the end of the guidance note. And also you have the FAQs in CARO, which can really help you. Thank you.
Thank you, Deepa. Now this question is for Anita. We have heard about GAAP measures and non-GAAP measures. We will highlight here non-GAAP measures. What is non-GAAP measures, and what are the common non-GAAP measures reported in company's report?
Okay. How many of you understand non-GAAP measure? Have you heard of it? What is non-GAAP measure? Nobody? It's okay. So we are going to learn today. So that's the spirit. So non-GAAP measures. The GAAP measure means anything which the standard requires. The GAAP is generally accepted accounting practices, which is nothing but our accounting standard. It could be Ind AS, Indian GAAP, IFRS, US GAAP, right? Generally used standards. Anything which the standard requires becomes the GAAP measure. Measure means the manner in which the company measure their performance, right? So the GAAP measure, which means the measure which is suggested by the standard. Example of that could be profit. Profit is a GAAP measure, right? It is derived when you account for revenue as per the standard, expenses as per the standard, and the standard also requires you to report the profit as well. Now we understand what is non-GAAP measure, right? Which is not by the standard, right? So the very fact that non-GAAP is not required by the standard, there is no requirement by the standard or any other regulatory matters that this number has to be disclosed. Still the company disclosed that number, so it's become a non-GAAP measure. One of the fundamental principle one to remember is the non-GAAP measure is always start from the GAAP measure. Okay, so the example is you take a GAAP measure, which is for example a profit number, plus or minus something, and arrive at the number which is not required otherwise by the standard becomes a non-GAAP measure. Now with this definition, anybody here can tell me an example of a non-GAAP measure, and I believe and I want to bet it that you have come across this non-GAAP measure in every day of life. It's just that you did not realize it is a non-GAAP measure. Any example? One example, and I'm sure you have come across this for sure, which is not a GAAP measure. It is actually a non-GAAP measure, but we were not aware so far.
EBITDA?
Yeah. Does the EBITDA rings a bell? Right? Earning before interest, tax, and depreciation, right? Most of the balance sheet we see, most of the financial statement we see, the companies talk about EBITDA. As again explaining profit, they start explaining their EBITDA. So very, very commonly used across the globe, not only in India, is EBITDA. It's actually a non-GAAP measure. It is not a GAAP measure. There is no accounting standard or no regulatory requirement which requires a company to present EBITDA. It's a voluntary presentation. So it is a non-GAAP measure. It's always derived from the GAAP measure, which is a profit. So you start with profit, add the interest, add taxation, add back depreciation and amortization, and come to a number which is called an EBITDA, and that is non-GAAP measure. So similarly, a lot of companies do present. Now the reason is, why do we require a non-GAAP measure when the standard doesn't require, regulators doesn't require? But many of the times, the company's true performance can be evaluated only by a non-GAAP measure. This is how management reviews it, right? This is how management believes that the company needs to be measured. For example, a company which is in a very capital-intensive company, or is in the initial year of their business, does not have a profit to measure them, right? Because they have a huge amount of interest sitting on their P&L, primarily because they have a debt, right? They have a huge amount of depreciation sitting on their P&L because of the reason they are capital intensive. So the true earning can be measured after you add back these numbers, right? How much actually the operation is. At that time, analyzing a profit can go wrong. And the management, obviously they're smart enough about their company, always measure their company on the form of EBITDA at that point in time. Sometimes the companies are structured in such a manner, in spite of not having a much of a profit, you'll say that tax position is very high because they are in different jurisdictions. Because of transfer pricing, they end up paying tax. So it is not correct to analyze, PAT or profit after tax to be the correct measure. And hence the non-GAAP plays an important role. One has to be very careful about it. Internationally, there are a lot of guidance about it. How much one can talk more about, one as in how much the company can talk about non-GAAP measure. Because it is a non-GAAP and you have a choice to curate it, anything you take a GAAP measure plus or minus something saying that my industry is not like this, I would like to add back these expenses and show this number and name that number something and call it as non-GAAP measure, because it's not driven by any four corners of the law or boundaries. It can be misleading at times. The company's management can use it for their favor, right? That they present you a rosy picture when it should not be. And hence, internationally, there are a lot of guidance available how much you can propagate about the non-GAAP measures. In India, we see the EBITDA is part of the financial statement, but generally there is a good amount of discouragement by the regulators or the law setters to be including the non-GAAP measures as a part of financial statement, because financial statement is in accordance with GAAP, right? So the non-GAAP measures, more or less, you'll find in the annual report in a section other than the financial statement. Okay, the other freely used non-GAAP measure would be free cash flow, right? So the companies which are again capital intensive or have deferred tax, these are all non-cash items, we understand, right? The investor want to understand how much cash the company is generating, not the profit, not EBITDA or otherwise. So the free cash flow is another way of companies projecting it, that your company, to the investors, the shareholders, the company's way of telling that your company generates so much of a free cash every year, right? The third or common example come across my mind is the pro forma earnings. What does a pro forma earning means? Again, a profit number, you take it, and then what you do is any unusual item in a particular year or any particular transaction cost, expense which is only for a year, but it's such a huge amount that it vitiates the entire performance of the company. So minus that, it's called becomes a pro forma earning. and that performer earning is the actual performance of the company for that year. So the non-GAAP measures is a very good thing, very good measure to analyze financial, health of a company. But it's a two-edged sword, so one has to be very careful when the management is using it for their favors. You'll always find it is in other sections. That's broadly about the non-GAAP measure. I mean, I can later on take question about it. It's a topic which is close to my heart as well, because it has a lot of controversies in its own, and very, directionally has to be chosen very carefully about it, yeah.
Thank you, Anita. Now this question is for Padam Shri. What are off-balance sheet items and how do we spot them in financial statements? And what is their
Yeah.
impact in the financial statement?
Yeah. So off balance sheet items, it's also something similar to non-GAAP measure. Now off balance sheet items are not derived by management's fancy, because actually management wants to keep it at bay. If possible, these are items that they never want to disclose at all or give as minimal disclosure as possible, because those are the things that can later on become either a issue or a good thing on the balance sheet. So off balance sheet items are something what we call as where we do not pass an entry for it directly based on the understanding of the accounting standards or the principles of the accounting that we do, but it is always sitting. So it is, you're sitting on the chair with a time bomb below it. It can either explode or go off. So it's always like that. And that is off balance sheet item which are largely in the notes to accounts. Now one thing I would like to bring to everyone's attention is that there are lots of private limited companies that have disclosure issues. Lots and lots of companies which have disclosure issues. They do not give all the disclosures that are required by the base pizza also and the topping also. Right? So here comes the issue how to analyze that kind of balance sheets. If the disclosure is not properly given, the analysis, whatever you do, it goes for a toss. You actually cannot measure anything. Coming to off balance sheet items, these are obviously the running of the business, the decisions that they take, the things that they do which impact. Examples of off balance sheet items are like contingent liability. Right? What is contingent liability? The company may have huge number of tax cases, GST cases, past service tax, sales tax cases, I don't know, because litigations go on for many years. Right? You don't just open a tax assessment and tomorrow it is over. Even after faceless, it's not so easy. Correct? So it goes on for a while, and then you go to next level, then the next level, then the IT, AT and High Court, Supreme Court, you can go to any level, it goes on. So there are lots of litigations open. Also there may be customer complaints, there can be other civil court laws, there can be land disputes, right? So all these things sit in your contingent liability. Say your balance sheet size is 100 crore and the contingent liability is 300 crore. Do you see a problem? Yes. So that's how you have to analyze. So it's not directly getting into the balance sheet, but at the same time it is sitting just outside the balance sheet, like you open the door and it is in. So that is why we do that PPR analysis based on the requirement of the accounting standard. We say whether it is, coming in, going out, or whether it is stuck on the door. बाहर जाने दे रहा कि नहीं? उधर ही खड़ा है तो how will you go out? That is one example. Second, any major decisions that is taken by the company, which are actually written in the director's report or as part of notes. Actually, those kind of decisions have to be written in the notes also, because it significantly impacts any subsequent event or any kind of decision taken by the management. For example, it has 3 plants. It wants to shift one plant to another place or shut down one plant. It may have a huge impact. It may want to sell a big piece of machinery. So 31st March over, we make the balance sheet, say I'm not talking about listed companies, just for example, we are making the balance sheet on 30th September. आधा साल निकल गया दूसरा, right? आधे साल में बहुत कुछ हो सकता है. And in most of the private limited companies, we also know that the minutes are not written when it is to be written.
Yes, definitely.
Right? That is the second level of problem or the bigger level of problem. So we need to have those information, those subsequent events have to come out and it has to be written here. So sometimes what happens, the information that is sitting in the director's report is not reflected in the notes to accounts. They don't tie up to each other. तो हमको वो extra information भी पढ़ना पड़ेगा in order to analyze. So if the company has said that okay, this plant is to be shut down, what is the implication? There may be a going concern issue itself. As Deepa discussed, I think going concern is one of the significant things. We may have to look at the going concern issue. In the past session, we talked about derivative. Right? If there are too many open unhedged contracts, right, that also is a liability. Operating leases, if the future commitments, operating leases or financial leases or leases as per Ind AS, whatever you take, if there are too many future commitments, you have to look at the balance sheet, how it reflects today. Whether the operating expenses are in line with the overall sales or it is actually falling off the chair. 10 जगह ऑफिस खोल के रखा है, पैसा भरने के लिए है क्या, is the question. Cash flow statement, it's not an off balance sheet item but a summary of the cash flow, a summary of the things that happen in the financial statement. But how many of us actually look into the cash flow statement? Whether the operating losses, if it goes into operating losses, it is a big indicator. You have 3 types of sections in cash flow, right? The operating goes into negative, you have a big indicator. So these are the places which actually off balance sheet, reading the notes, reading the director's report, reading the contingent liability, reading many of these, additional spots is all necessary to collate and get the information back to the balance sheet. So if we have a balance sheet which has 10 items, these 10 items when plotted against each of the financial statement item, if the balance sheet is getting into negative or near to 0, you have bigger concern. If the contingent liability is such that you have 300 CR case and then the existing asset size is only 100, you have to worry. Then that goes back to your investment, your analysis. Even at the time of taking up the audit, you have to do this analysis. This is what is the requirement of your SQC, right? And the upcoming ISQM. Your client acceptance process has to be such robust that you have to do the analysis of the financial statements. Now this is again not another off balance sheet item, but the qualification that is sitting in the auditor's report of the previous year. It can have a major impact on one of the line item. If I say depreciation is not properly charged, so we have to think if depreciation gets properly charged, what will be the value of the asset? If I say liability to this tune is not provided for, that means 100 minus how much? What will be the balance? So these are the relations, interrelations that we have to do, right? And that is why this cross tally of CARO versus Schedule 3 versus CARO is actually given. There the question is whether the chicken came first or the egg came first. We did not order for either, but both came, right? So there is a correlation between these things, but then these things have to be seen from the reflective purpose on the balance sheet and the P&L itself. If I provide for, what is the impact? If this contingent liability becomes liability, then what is the case? If they shut down the plant, what is the case? So these are the things that we have to grab, and that's the real analysis of the financial statements. It's not only the numbers, the comparatives, but this is the real analysis of the financial statement. Number सब कुछ अच्छा दिख रहा होगा, 6 महीने बाद दुकान बंद. What is the use? Right? So we have to give that angle of thought always.
Thank you, Padam Shri. So now we are aware that now off balance sheet item we should focus on before taking any assignment, that what are their contingent liabilities, is there any order order issued to the company or not, any contingent liability is there or any demand has been penalized on the company. Now this question is to Anita. What is the other information, how this other information in annual report help in financial statement analysis?
Okay, so we heard about the off-balance sheet items. how the other information different, way different from the this off-balance sheet items. The off-balance sheet items, why they are outside balance sheet, but they are still housed within the overall financial statement somewhere, right? Generally underneath the balance sheet or in the notes to accounts, or as Padmashri was mentioning, is part of the audit report, which is also the part of the financial statement section. The other information is everything other than the financial statements. So if you're familiar with, or if you've read the annual report of any company, there are various segments to it. There are segments which talk about the chairman's speech, then the agenda of the annual general meeting notice, then there is a director's report, then there is a MD&A analysis, then there's a financial statement, so on and so forth. And so these are the various sections of the annual report. Mine is the financial statement in this report, annual report. Everything else is the other financial information. Now, this other financial information is actually key while you're performing an analysis of a financial statement. There is a lot more information hidden in this, which at times we forget to analyze because our focus is primarily the financial statement analysis, right? But financial statement give you number crunching. The real reason for that variance or for any negative trend or any other reason comes from this other financial information. Now, I'll touch upon few of these other financial statement, the financial information, which are the various segments of the annual report. But my suggestion to everyone would be read the entire annual report cover to cover. It has a lot more information than the financial statement, and it gives a lot more clarity about the information which is also there in the financial statement. Now, one of the things which to start with is the company's vision and mission statement. What do the company stand for, right? Some company wants to be the best performer, best service provider. Somebody wants to be the best employer. That drives the company enterprise's entire spend, their entire goal towards achieving what they want to become. Not everybody want to become a billion-dollar company alone, right? So that's the first thing which gives you an overall tone about the management, in which direction do they think while making a decision about any spend or any other thing. The other section is the product information and the financial information of last 5 to 10 years. Now, this is again a key information. What are the present product company has? What are the plans for the future products? How the company is planning to expand, right? So a lot more information comes in that section, which will help you understand that when you're reading the current year financial statement, it may not be true for the next year, right? It may not be because the company is launching a big plant, company is launching a big segment, or company is investing heavily into another, line of a business. So absolutely the next year's financial statement could be completely different or could be double or half of it if they are planning a demerger or plan to discontinue a product line. Similarly, the information about 5 to 10 years of a financial information or selected financial information gives a lot more about the trend of the company, about in various economic scenario how the company has performed. So if a company's last year 10 years performance, if you see in last 10 years COVID happened, inflation happened, layoffs happened, various economic scenarios India has gone through it, right? In those economic scenarios, how the company's performance got affected. If not got affected at all, there is good and bad to it. There is a good that the company is sustainable. In spite of COVID happening, the company survived. But even in a good economic scenario, if the company did not make it, there's still a thought to it, right? So this 10 years gives a good amount of a gestation of how the company respond to the external things which are outside the company's control. So this is absolutely clear, critical, and gives you a lot more information when you are analyzing the financial performance of the company. The third section, which gives you a lot more info or insight about the current year's performance of the company. When you're reading at, say, the March 2024 balance sheet or P&L of a company, how does that P&L or balance sheet should be read from a management perspective is the area which you find in director's report. In the director report, they explain the critical financial line items. They also explain about the segment of the company's revenue. They explain about the key contract company won, because of it, whatever XYZ, the revenue numbers look different, or they announced a layoff scheme for employees, because of which you see the employee cost down. So a lot more things get explained in the director's report, which again helps you understand the financial statement the way they are. So a sudden reduction in employee cost doesn't mean the company's into a cost cutting. Probably the company is closing down a major line of a business. Then it's a concern, right? It's not a good scenario. It's not a good thing that companies' costs are going down. So always read current year's financial performance with the director's report, which provide lot more information. One of the key things, and this is like a more qualitative when I read it, and it's my notation, may or may not be correct, but after reading like 20 years of experience of reading annual report, the tone in the director's report says a lot. So if the tone is positive, you will realize that in that year the company has done good job, right? They have outperformed, and that's why the tone of the director's report is more positive. The year in which the company has not performed very good, the tone is generally negative, or they are blaming on the external factors. So if they have not mentioned that we have done bad to their budget, which you are not aware of it, but when you read the tone of the language of the director's report, you could visualize that what they are doing is explaining their poor performance. So the tone becomes very important. And the last section is the MD&A, Management Discussion and Analysis section of the annual report, which gives you a lot more beyond the company. So we talked about past performance of the company, current performance of the company, now how the industry in the same in which the company operate has performed. And is the company is in line with industry, or they are completely off the industry? So that section you will find in Management Discussion and Analysis, where the company explain about the industry trend and how they have performed as compared to industry. They also give their SWOT analysis, what are their strength, weakness, opportunities, threat. The company also talk about their challenges, their threat. Sometimes they are vulnerable to the currency fluctuation because of their operations, right? Any fluctuation in foreign currency affects them. Sometimes they are vulnerable to any changes in the law. For example, if it's a telecom company, they are so driven by the law, any changes in the tariff or any changes in the law affects them, poorly. So, or poorly or better, whatever way. So it is important for us to know that company operates in which industry and how the company in the current year or in the past 10 years have performed as per the industry. That section you will find in MD&A. So these are the areas I think you cannot read financial statement in isolation. You'll more often than not will come out with the wrong analysis unless you read along with
Other
these information which are readily available. You don't have to research anywhere outside. It's readily available on the annual report.
And the report only.
Yes, that's true.
Thank you, Anita. Now the time is pressing, and we have to complete it by 1:15 or so. So the question is for Deepa. Can you suggest some resources which our CA colleague fellow can refer as a role of statutory auditors?
Okay. So thanks, and I would just highlight that because we are talking so much about the financial statement, there are very good checklists issued by the ICAI. So if all of you have not looked at it, look at the checklist on the accounting standard checklist, both for your accounting standard and your Ind AS. That should be used even in your audits of financial statements. The second is the auditing standard checklist. I think those are very good checklists that also you can refer. In addition to that, there are technical guides on the LLPs and on the non-corporate entities, wherein you have the illustrative financial statements as well. Then time permitting, you should also attempt to, read the FRRP publication. In the ICAI General, they cover, monthly articles capturing the summary of the observations, wherein they highlight what is correct or what is incorrect. And if anybody is more interested, they can go to the NAFRA website. There are 4 reports issued by the NAFRA for the companies which talk about the disclosure. So just as a message, you should please keep on reading, look at the various pronouncements issued by the various regulators, keep yourself updated, and block some time during your week to, which you can say a reading time, because I think in our profession also, the information becomes outdated very quickly. So, there is a lot to be done to make sure that we are quite updated and using the updated resources. Thank you.
Thank you, Deepa. Now, quickly, Anita, can you give some insight on technology transformation?
So
For
technology is
financial
affecting all of us in our day-to-day, every part of our life. And financial statement analysis is no different than it. Obviously, the technology makes the financial statement analysis, one, quicker. it makes it more, you can do it more frequently as compared to when you do it manually. There are a lot of technological tools available, for example, Python, SQL, Power BI. What technology can do, which is very difficult when you do financial analysis as manually. One is when you do manually, there could be a bias, there could be human error. Technology eliminate that. If the data or the volume of the data is huge, for example, you're assessing a 10 years performance of a company by segment, by product line, by manufacturing unit, it becomes a good amount of a data, and humanly processing this much amount of a data becomes at time very cumbersome. Technology would do it as much as of a data you can provide. Most of these tools are compatible to handle big data. The third thing is when we as a human do it, we tend to do it annually once, right? With the technology, once the data is feeded, you can do it repetitively. If you want to do it for your quarterly reviews also, you can do that. If you want to do it for a particular month where there's a huge fluctuation, whereas, remove the another 11 months, or in a quarter, remove the other 2 months, that possible. So you can build up multiple scenarios, and the frequency of these analysis can become multifold as compared to only doing 1 year, or once in a year, or 4 quarters in a year, humanly, which I believe helps a lot to analyze the data in a rightful manner. So these are the technological advances or benefit of using technology in financial statement analysis. Also, using a technology, some of the high-end technologies also gives you a report. Right, after you analyze, it just doesn't throw out you the outliers, but it gives you a proper report, which is worth a documentation. The auditor friends here would understand what's the meaning of it. The documentation is key for us, right? After doing everything, it can't just reside in our brain. So it gives you a good documentation. It can make your data or your analysis more presentable. You can create dashboard out of it. You can create a pie chart or varied kind of a chart, pivot tables out of it. So it helps a lot more presentable,
Yes,
time
it
saver,
saves time.
number of times, big data. I think I can go on and on for the technological, help which gets in financial statement analysis. Yeah.
Thank you so much, Anita. Now, quickly, Anjali ma'am, please wrap up with the last question. What is the difference between CSR and the sustainability?
I will keep it brief because we want questions from audience. Basically, sustainability is a very, very long term as compared to CSR. It is permanent, whereas CSR is one time. It is basically creating long-term value in business. Business creates strategies that governs the ESG principles, that is respecting environment, social and governance principles. And it is in the process itself, we are creating those strategies, those that will be respecting these aspects. Whereas CSR in India, all of us know that we comply the section 135, 2% of the average net profits, trees उगा लिए, NGO को contribute किया. So it is one time. We have not gone to that stage where businesses really look for sustainability. So sustainability is a very long term. Of course, good companies like Tata's, Reliance, they are trying to recreate their business processes so as to reduce the carbon footprints and conserve resources. That's it.
Thank you so much,
And now
Anjali ma'am.
we'll take
So it's
questions from audience.
Yeah, it's been an insightful discussion. We have heard from the diverse perspective on the interpretation of financial statement. Now, floor is open for the questions from the audience. Please raise your hand and yes.
जो आपने फाइनेंशियल स्टेटमेंट के बारे में बात करी, यदि कुछ न्यू एंटरप्रेन्योर है और मतलब फर्स्ट ईयर या सेकंड ईयर में ही उनको ऑडिट लगता है और उनके पास ओल्ड कंपैरेटिव फाइनेंशियल स्टेटमेंट्स नहीं है, तो इन दैट केस हाउ डू की पॉइंट्स की वी एक्सेप्ट द ऑडिट एंड व्हाट शुड वी हैव टू नोटिस एट दैट टाइम. समटाइम्स डिसीजन इसमें लेने में प्रॉब्लम आती है कि हमको एक्सेप्ट करना है.
Correct.
राइट. सो अगर आप एसक्यूसी पढ़ेंगे हाँ जी, अगर आप SQC पढ़ेंगे तो उसमें क्लाइंट एक्सेप्टेंस कैसे किया जा सकता है वो पूरी तरह से लिखा हुआ है. सो देर sometimes these are the type of situations where we fall in its first year, second year, we don't have much data, and even if there is some data, it is not much used. So there the questions that fall into your plot is the intention of the management. You have to have extensive discussions with the key managerial personnel, with the management, see the underlying whatever documents that they have. फॉर एग्जाम्पल उसने बिजनेस चालू करी होगी तो कुछ तो उसने वो प्रोजेक्शन बनाया होगा, सेल्स कॉन्ट्रैक्ट उसके पास होगा, सम बेसिक डेटा होगा, सप्लायर उसके कैसे. तो फिर यू कैन गो अ स्टेप अहेड टू डू व्हाट काइंड ऑफ थिंग्स दैट दे आर गोइंग टू डील विथ, हु आर द पीपल दे आर गोइंग टू डील विथ. जस्ट टू गिव यू एन एग्जाम्पल, इफ इट इज़ अ न्यू कंपनी, however he is going to be funded by a company which is actually illegally making money. Question is, do you want to take it? Answer is clear, right? So there where the data is no limited, that you don't have financial statement of that guy, you will have to go a step beyond and see the related people. Who are the promoters? Who is the management? Promoter का क्या history है? Promoter का क्या background है? पता चला वो कोई और कंट्री में कोई स्कैम करके इधर आके कोई बिजनेस खोल रहा है. सो देर आर टूल्स अवेलेबल इन द मार्केट, समथिंग लाइक है 2-4 टूल, लाइक वर्ल्ड चेक बोलते हैं, ग्लोबल चेक बोलते हैं, ऐसा सॉफ्टवेयर अवेलेबल है. तो इन दैट व्हेन यू चेक, यू विल गेट द हिस्ट्री जोग्राफी ऑफ दैट पर्सन फ्रॉम अक्रॉस द वर्ल्ड. टुडे ग्लोब इज अ स्मॉल स्पेस, राइट? बैकग्राउंड चेक करने के लिए आपको CBI या FBI बनने की ज़रूरत नहीं है. देर आर सॉफ्टवेयर अवेलेबल. Wherever, even in a civil court, district court, magistrate court of any country, even in the smallest island, okay, you will get that history. So at times, if your business proposition is larger, आपको लगता है कि ये कंपनी आगे जाके बढ़ने वाला है और मेरे को उसके साथ रिलेशनशिप मेंटेन करना है, तो you will have to invest in this kind of little bit of, extra investigation, maybe.
Okay, thank you, ma'am.
Or a management should give weightage to the the EBITDA profitability as well as to the cash flow, cash liquidity.
So, do you mean by, as an investor, how you should analyze it? Is that your question? If I
From
understand.
investors' angle and from the management angle, while analyzing business performance.
Okay, so there is something called KPIs, if you guys would have heard of it, the key performance indicators, right? Every business owners know what is their key performance indicator, right? That's the indicator which indicate is the business going right or not, or is the business going as they planned it to be. Now, the key performance indicator may not be a financial number. It can be, for example, for Zomato, it could be a number of orders they deliver, right? For an airline company, it would be a number of routes on which they fly. For hospitality industry, it could be the number of rooms they sold or average occupancy they have. So the key performance indicators, there are ways, there are internationally guidance available how the management should identify a key performance indicator for their company. Obviously, it stem a lot from the industry in which you operate. Being an airline company, you cannot measure your key performance indicator based on the fuel cost, because that's not how others in the industry are doing it, right? So your key performance indicators primarily stem from the industry in which you operate. As in management, when I'm answering it to you, when you have to go about it, that how do I measure my performance, or how do I do a financial statement analysis? So it stems from industry, and then there are ways in which there are also professionals who are available to help you identify. It's generally happen, and now there's the requirements of SEBI also, especially for the companies which are going for public, also to indicate their key performance indicators. It goes with the laundry list of key performance indicators, like you identify 20, 25 key performance indicator, but that's a lot, right? that becomes too generic. Then you boil down 25 to 5, and that becomes the key performance indicator. As the name suggests, it has to be key. It cannot be generic performance indicator. So you boil down from 25 to 5, that these 5 are my key performance indicator. It's not necessary as a management that profit is always your key performance indicator. And it is not necessary once you decide a key performance indicator, in a year one, it remains same for throughout the year. Let me take an example of a startup company, right? The initial year, it could be the fundraise. Later on year, it could be the capital invested, right? The amount of investment you do, capital expenditure. It's only when you start recording a sales, it could be for few years, it still could be the number of contract, number of revenues, how much is your top line. It probably could be after 8-10 years, you start thinking profit as your key performance indicator, right? So it could be different in different year. It could be different for different company. There is no off-the-shelf answer for your question that if I'm a management, what should be my key indicator which I should analyze for financial statement, and each management has to develop their own. There's enough guidance available how you should go about developing it for it. So I'm not able to give you a quick answer that it should be profit, because that would be wrong, right? One has to do the exercise of developing it. Now, coming from the stakeholders' perspective or investors' perspective, primarily it is return on investment, like we all understand the money language. Also, from an investor point of view, what management see is, as I mentioned about it, various part of the annual report, it is mentioned. What do they weightage, what is non-GAAP measures they look at, what is the KPIs they look at. That will help as an investor also to drive how the company is performing. The company may not be performing good on it, but their KPI is revenue. So if the company is performing good on revenue, which means in those years the company is performing good in spite of no good profit, because the company was working toward building revenue, right? So this is how one should. Hope that answer your question. I mean, you still have a doubt, I can elaborate more or can meet you outside.
Yes, it's basically from the compared to the industry, that organization particularly is doing good on the track, and from that angle I was asking about. But yes, it answers.
It answers your question. Good. I'm glad.
Thank you. Now, heartfelt. Is there any question?
It was like a very insightful discussion. Something add on this question, like being an investor, like you guys are like more expert on looking at the financial analysis, right? Financial statement. So like you said, like from there are 25, 30 indicators are there. From list down, you go with the 5 indicators. Now, for as a layman or what I can say that I'm moreoverly I can understand the financial statement, but I'm not expert. So which 5 indicator I should be taken into the consideration? Because like, look, I am a technical guy. I can understand the price. Now here everyone is more expert on the financial. So वो कौन सी 5 चीज़ें मुझे देखनी चाहिए? जैसे प्रॉफिट से कुछ नहीं होगा. जैसे हम मतलब प्रोफेशनल फंड मैनेजर, so what I feel according to my logic कि पैसा बन रहा है तो अच्छा ही होगा, राइट? सो पैसे अगर प्रॉफिट अच्छा हो रहा है तो प्रॉफिट के अलावा और कौन सी चीज़ें होती है, जैसे कि लाइक EPS, PE, प्रमोटर होल्डिंग, दिस मच प्रमोटर होल्डिंग शुड बी देयर. सो कैन यू जस्ट लिस्ट डाउन सम ऑफ द 5 indicators which a person can use, 5 or 7, or which you feel that बड़ा पिक्चर इससे पता चल जाएगा?
Okay, I'll make an attempt and then I'll ask other colleagues to add as well.
Okay, sure.
So I was there present for your session as well. So from obviously the stock market price movement is not always the indicator of the company's performance, right? There are days when the companies perform good also, and we've seen that stock not moving in. So there's a lot more beyond companies' control. There are a lot more market condition. So keeping that aside, stock market movement. Now the company's financial statement, the key indicators is, as I said, that you look for it what management see as a key indicator, right? Which I told you about some of the section where you can find. Those 5 key indicators, which is mentioned at the different places, are your key indicators which you should evaluate the companies on the performance, right? A listed company, in our part of the world as an auditor, we believe a listed company which is doing a fair amount of operation and they are earning profit, but there's no much of a fluctuation in profit. Like they're not at the break even, they are not somebody who are seasonal into the business. There are a lot of businesses which are seasonal. These are not seasonal businesses. So you need to do a little bit of homework before you dive into these indicators. We believe profit is something what the investor look at, right? That's our belief of it. After profit, revenue is the secondary area where the investor look at by looking at the balance sheet when the companies are listed. The companies which are startup, the indicators could be completely different. As I gave you an example of a Zomato, they themselves value them on the basis of the number of orders they deliver. Okay, the number
So
of.
is there any percentage numbers we need to look in, like profit numbers, like if a company should be grow with the 15% or 20% growth or 10%, can we have that calculative numbers
No,
we
so
should use?
again homework, no off-the-shelf answer, because the companies which we are talking about is a worldwide, every segment, every industry, they cannot be one shoe fit all, right? So you have to see the company operates in which industry. If the industry itself is making a 10% profit and your company makes a 30%, it's not a great thing to be. In the long run, as per your chart, it has to come to the average, right? Yes. In long run, it cannot be always above the chart. It cannot always be lower the chart. So you understand, at least, right, of all the people. In the long run, the market has to give you a return which is more stable as compared to a short term can be 30% or short term can be 50%, but in the long run. So if the entire industry is making a 10% profit, your company making a 80%, would be a very short term or could not be a very indicative of what the company's performance is, right? It could be a one-time fling or it could be a one-time gain on something. So, and hence the analysis of more than 1 year is always suggested. The suggested analysis is not always the 1 year. It's always 3 to 5 years at minimum. You can go up to 10. Beyond 10, then you get we get lost in the generic reason, because then multiple scenarios get developed, right? So the ideal is 3 to 5 years. What is it? And that's how the indicators goes on and on. But I'll let others also participate.
Quickly.
Us for lunch.
Okay. So we can talk more about it. Quickly 5 things that you said: profit, revenue, indicator as per industry, the overall benchmarking from the market perspective, and the economy and the geography. It can be completely different for NSE, it can be different for BSE, it can be different for NASDAQ.
One last thing, auditor's report.
Yes.
Read the language.
So on behalf of ICAI Ahmedabad branch, we would like to say thank you so much to Padam Shri ma'am, Deepa ma'am, Anita ma'am and Anjali ma'am for delivering such a fruitful knowledge about the financial statement analysis, schedule 3, revised Caro, gap and non-gap measurement, and audit checklist, and many more points covered in this session. Thank you so much. Thank you. And now we have a lunch break for 10 to 15 minutes. सब लोग जल्दी से लंच करके ऊपर आ जाना. लंच बहुत अच्छा है, इसका मतलब ये नहीं कि नीचे ही खड़े रहना. ब्रेकफास्ट की तरह ब्रेकफास्ट भी किया, लंच करके सीधा ऊपर आ जाना. थैंक यू सो मच.